In this video, I'll cover a very important topic that mainly relates to my experience and journey, but I think it can be useful for many people as well. Specifically, we'll talk about how I've managed to simplify my trading strategy to such a level that the process of analysis, decision-making, and overall understanding has become better and simpler. Let's start from a bit further back. Why do we need to look for ways to simplify our trading strategy? First, I'll say this. A simplified strategy isn't primitive, it's clarity. The market is a place of chaos and you need to understand what's what in all of this. Therefore, when the system is simple and clear, you know exactly what the logic is, why you enter a trade, why you exit, what to do in difficult situations. Secondly, the simpler the strategy, the more reliable it is in the long term. Many forget that markets are constantly changing. Complex systems quickly break down under new conditions because they are too tied to specific parameters. Simple strategies adapt more easily because you focus on what's essential. You can easily see what works and what doesn't. Any changes can be quickly tested and implemented. In my analysis and decision-making process, I rely on four main variables. The first three, order block, fair value gap, and rejection block, essentially represent price zones. The fourth variable, fractal points, specifically fractal high and low, represents price levels. So all I have are two categories, price zones and price levels, which makes for an extremely straightforward concept. However, these four variables can be further divided into two categories depending on their potential impact on the market. The first category includes fair value gaps and fractal points, which I call high-impact variables. Why? Simply because the market moves because of them. All major reversals are often determined by the interaction of price with these variables. Consequently, we can conclude that they provide the greatest amount of liquidity to the market and have the greatest influence. The second category, as you've probably guessed, is order block and rejection block. I call them low impact, but you don't even have to assign any name. It all depends on individual preferences. While these variables play a significant role in many aspects of the market, in my opinion, they are not the driving force themselves, but rather, let's say, additional context that shows the characteristics of past price action. Forming a trading idea. Trading idea is a hypothesis based on market variables and other economic indicators, suggesting that the price will move from one price zone or level to another, typically on equivalent timeframes relative to each other. Here is how the basic formula looks. This means that a trading idea always has a clear beginning and end, or a cause and effect relationship. In practical terms, this can be defined as initial price zone, or level, and final price zone, or level. Pay special attention to the fact that variables forming the initial price zone or level can belong to either the low impact or high impact category. At the same time, the final price zone or level, in most cases, consists of variables from the high impact category, except under certain conditions. This is because we always strive to maximize profit from a price movement. Therefore, the areas where there will be the highest probability of reversal pose a danger to us, which is why they should serve as rational targets. In order to form any trading idea based on the variables found during analysis, it is necessary to answer several questions objectively. If this can be accomplished, then the idea can be considered sufficiently well-founded for further consideration. The first question is from where? You need to identify where the price started its movement from, which variables provoked or could provoke a reaction and reversal. The second question is to where? Where will the price likely be delivered in the context of the reaction? At what values might there be a strong counter-reaction? And the last question is how? How will the price move from one place to another? Through what elements or factors? These are basic questions that need a complete and well-thought-out answer. Types of trading ideas. It's important to understand that depending on the time frame used for forming a trading idea, they can be divided into two types, each describing different scales of price movement while maintaining the same basic logic. First are global ideas, which involve large time intervals and price ranges, usually located on monthly, weekly, and daily timeframes. Local ideas are more short-term and often correspond to daily, 4-hour, hourly, and 15-minute timeframes. This is regarding my vision on this matter and trading style. If you have a different trading style, such as scalping, and you want to use this approach on lower timeframes, then even 1 hour could be considered global ideas for you. This is quite subjective. Moreover, Local ideas can exist within the context of global ones, and at least one of the trader's main tasks is to try to synchronize them in the same direction to increase the probability of a positive outcome. Okay. Once a trading idea is clearly formed and meets all the criteria, it should be validated for further decision-making and monetization under the standard approach. Validation itself always implies receiving a confirmation signal one time frame lower, which can only be in the form of a price zone formed as a result, in the context, of testing the initial price zone or level that serves as the foundation of the entire idea. In other words, if a specific price zone or level is tested, and afterward another price zone forms, validation has effectively occurred. However, it's necessary to consider the specific characteristics of each variable to achieve the highest probability that the price is truly ready to move in the anticipated direction. Again, you can see the basic formula of this logic. Validation specifics. In cases when a price zone has been identified but there is also an additional price zone or level, variable from the high-impact category, inside or before it on one time frame lower, then there are two options for how to proceed. The first option is the simplest, as it maintains the standard validation approach one time frame lower relative to the initial price zone, while also taking into account an additional variable, which can be either a fractal point, fair value gap, or both simultaneously, which often act as reversal accelerators and can provide an understanding of exactly where this will occur. The second option is a bit more complex as it involves validating the initial price zone 2 time frames lower, provided that the additional variable is exclusively a fractal point. However, with this approach, it is also possible to use fair value gap as an additional variable, as long as it is not used for validating the initial price zone. This means it's an even deeper context, where we work 3 or maybe even 4 time frames lower and try to synchronize them. The formula is in front of you again. Invalidation criteria. Invalidation criteria are an essential part of the decision-making process as they provide the ability to understand when a particular trading idea loses its relevance and should no longer be considered. It's important to understand that we are not invalidating the trading idea itself, but rather the price zone or level on which it's based. This is purely a technical matter. First, any price zone becomes invalidated if it is completely broken through, with price moving beyond its boundaries by even 1 point. When a price zone is a fair value gap, it can be invalidated if a candle closes with its body covering the entire range on the same time frame, provided that subsequent validation was expected. In other words, the FVG served as our initial price zone from which we expected to get a reaction. Secondly, a price level becomes invalidated if there is no reaction upon interaction with it, and the movement continues without any signs of receiving a confirmation signal afterwards. That's all for this part. Let's move on. Everyone's favorite trouble areas. Trouble areas represent specific price zones or levels that may exist within already established trading ideas and can interfere with their execution or even lead to complete invalidation. If 2 or 3 variables were used during the validation of any trading idea on different timeframes, then it should be taken into account that each of them can have its own associated trouble area on the corresponding timeframe. Based on this, even the final price zone or level is essentially a trouble area for the initial. And as already mentioned, in most cases, a trouble area consists specifically of variables from the high-impact category, but there is an exception which states that any order block rejection block can have a sufficiently significant influence on the execution of a trading idea, provided that it follows high-resistance logic. Therefore, one needs to be careful with this. For those who don't know what high resistance is, I'll quickly explain. High resistance refers to all variables that have interacted with a price zone or level from the high-impact category on the same time frame, and also have a fractal point as a confirmed extreme, behind which it is generally safe to place your stop loss, because there is an increased probability that the price will reverse before reaching it. Essentially, this is the entire foundation of my trading strategy that I use on a daily basis. Beyond this, everything else involves forming various trade management rules, entry models, risk management, and so on. But the foundation remains unchanged. But I want to show you one more thing. It's not always necessary to validate an idea to monetize it. This isn't mandatory. There's a trading approach called instant decision. When a high-probability trading idea has been identified, an entry is immediately made from the initial price zone or from an additional variable from the high-impact category 1 time frame lower. In short, we simply open a position without validation. Stop loss in such cases is placed as usual behind the movement extremes, but there is a small difference again with the fair value gap. Since this element can form anywhere on the chart and can be as wide as possible, the stop loss can be placed at its lower or upper boundary depending on the direction, provided that the entry is made from a price level, that is, a fractal point inside it. The logic is that if the price completely covers the FVG, it will be considered weak, and your trading idea will simply cease to be relevant. Instant decision is essentially trading reversals from supply and demand zones that many great traders used in the past, and I think many still successfully apply it today. We'll talk about this in other videos, but that's all for today. Thank you for watching until the end. Don't forget to subscribe to the channel and give this video a like. See you soon.